History has shown us something important. Inflation does not always fall in a straight line. Sometimes it comes in waves, and sometimes the second wave is worse than the first. On the screen, so it's a structural comparison. It's a structural comparison of what happened then and what I believe is about to happen. And when we combine this chart with a recent Financial Times reporting that, they basically stated that Federal Reserve officials warn progress toward the inflation goal will be uneven, which is a subliminal message for don't expect any rate cut soon. And also the article on that the U.S. markets and the economy are entering uncharted territory, quote unquote. We begin to see something deeper, something more serious. How to read this chart? This chart basically compares two inflation periods. The modern period, roughly 2014 through today, and the 1966 to 1982 period. You'll see two lines. The green lines represent recent core CPI. That's inflation excluding food and energy. The blue line represents inflation from the 1974 to 1982. Here's something important. The chart uses two vertical axes. The left axis is for today's data, and the right axis is for the data from the 70s. So why am I using two scales? Because inflation in the 70s went much higher, into double digits, than today. So if we use one scale, the modern line would look very tiny. So these charts align patterns rather than raw levels. It's comparing shape, not exact numbers. And that shape is what matters. Look at the timeline at the bottom. You'll see the modern period laid over the older period. The idea is to show how the structure of inflation may be similar. Now notice the labels in the middle of the chart. The first inflation mountain, kind of in the middle, and that a first inflation mountain occurred in, as you look at the lower, in 1974 and also in 2022. Need I remind you what happened in 2022 with COVID and the money that was spent and a huge amount of inflation that ensued when the economy was reopened again. And at that time, the Fed didn't really act that fast because they thought this would be a transitory inflation, which it was not. And then later on, we have the second inflation mountain, and that phrase is key. So inflation rarely moves smoothly downward. Instead, it often behaves like this. It rises sharply, it peaks, it falls, and it stabilizes, and sometimes it rises again. That rise-fall pattern forms what looks like mountains. In the 70s, there were two major mountains. The first one came down. Policymakers. That was the Nixon era, and at that time, his Fed chair, which is now considered the worst Fed chair in history, Arthur Burns, look it up. And policymakers thought that they had won. Then the second one arrived, and that one was worse, as you could see. Now look at the green line. Let's do this inflation. We saw a surge after 2010, 2020, and 2021. We peaked, and inflation cooled. And now the big question is this the end? Or is this just a valley before another climb? So why does the 70s matter so much? Well, in the 70s, there were not just high inflation. It was unstable inflation. Policymakers would tighten policy. I mean, I don't have to remind you what happened all last year with the government, for right or wrong reason, decided that they needed lower and lower and lower rates, which they got. So policymakers would tighten policy and then inflation would fall. Then they would ease too early and inflation would return. That damaged credibility, and there's the same theme today, right? We're talking about is a Fed independent, and what I want for my subscribers and my members is I want you to understand what's happening before it happens, before you get hit. And every day in the morning, I talk to my members and explain to them, okay, this is what I'm doing. And one of the topic, obviously, that I started this morning, kind of started last week a little bit, is inflation. So at that time, markets suffered, bond yields soared, stock valuation compressed. The lesson, inflation can retreat and then return. And once expectations shift, it becomes harder to control. So what is the Financial Times also saying? Well, let's connect what they're saying. And the Financial Times recently quoted Federal Reserve officials saying, progress toward the inflation goal will be uneven. That word matters, right? Uneven means not smooth, not steady, not guaranteed. It means inflation may stall, it may bounce, it may refuse to go quietly to 2%. In another article, the Financial Times also described the economy and markets as heading into quote-unquote uncharted territory. That is strong language. Central bankers and serious financial journalists do not use those words lightly. Uncharted territory suggests high debt levels, elevated asset prices, tight monetary policy, political uncertainty, and structural global shifts. That is not a normal cycle. That's a complex, very complex cycle. So why would progress be uneven? So let's break this down. Why might inflation not fall smoothly? First of all, wages. Wage growth, if you work, has been sticky. Second, housing cost, shelter inflation, fiscal spending. The primary culprit in creating inflation is the government. Government deficits remain large, and of course, supply chains. They are more stable than in 2021, but global trade is fragmenting. And then, of course, you've got energy and commodities. These can turn quickly. 2 ships in the Middle East right now. If we start the bombing, oil prices are going to go up. Put all of that together and you get the bumpy road, not the straight line down. Now, could there be a second mountain? Well, let's look again at the chart, right? So the 70s show a second surge after inflation had cooled. That second surge was driven by oil shocks, loose policy, rising expectation, right? Now, loose policy means, believe it or not, Nixon got Arthur Burns to lower the rates at that time when there was a huge amount of inflation caused by the Vietnam War because the U.S. was spending a lot of money on weaponry. So today we don't have the same oil shock dynamic, but we have geopolitical tension, massive debt, fiscal expansion, and structural labor shortages. The ingredients are different, but the risk of persistence is real. So what are the market implications? Well, if inflation progress is uneven, markets react. Stocks depend on predictable rates. Bonds depend on stable inflation expectations. If inflation stalls above the target of 2%, the Fed keeps policy tight longer. Remember, we are almost 3% for the past year. They can't bring it down. That pressures valuation. The higher the rates, the lower the stock market. If inflation reaccelerates, policy could tighten again. That means that the Fed is going to say, sorry, I'm going to have to raise rates. You know what this is going to do to the stock market? That creates volatility. Gold often benefits from inflation uncertainty rises. Risk assets struggle when policy credibility is questioned. So you're in the middle of a psychology trap. Investors love the phrase, inflation is coming down. But markets price the future. If inflation gets stuck above 2%, that changes everything. The danger is not inflation itself. The danger is assuming it's fully defeated. So why is this cycle different? Well, because this is not the 70s. We have the highest public debt levels in decades ever. As the Fed chair says, it is manageable, but it is not sustainable. Asset valuation still elevated, aging demographics, political polarization, and global supply chain restructuring. So we're combining modern financial leverage with old inflation pressure. This is a new ground. That is what uncharted territory means. So instead of predicting one outcome, think in scenarios, okay? 1, inflation falls steadily to 2%. Rates fall, markets rally. Scenario 2, inflation stalls at 3%, which is what it is now. Rates stay higher for longer. In fact, they're already saying we may not want to lower rates any lower than this. Markets move sideways. And scenario 3, inflation rises again and policy tightens. Stock market drops. And with my members, I am starting to develop a strategy for myself as well in order for me to take advantage of this situation in case the markets start dropping, and hopefully educate my members in the process. So in closing, history does not copy exactly, but it often rhymes. The 70s teaches us that inflation can come in waves. The Financial Times reporting tells us policymakers know progress will not be smooth. And when officials use phrases like uneven and uncharted territory, we should listen, because markets do not collapse from various risks. They collapse from underestimated ones. If this analysis helps you to see the structure behind the headlines, I want you to subscribe. I want you to become a member if you want to learn more about it. And if you want to understand how rare events reshape the financial system, check out the Black Swan book that I will tag on this video. So stay disciplined and stay aware.